All right, let's try and understand what the quarter gone by was like, and more importantly, what are the trends emerging as far as investing in funds is concerned over the next quarter as well. Jiju, it was a quarter actually quite good, isn't it, from the point of view of assets under management? But if you were to go deeper down, what would your assessment be?
Yeah, so in terms of assets under management, the quarter has really seen a lot of money flowing into mutual funds. If you were to, split it between equities and debt, what is really noteworthy is that a lot of AUM has really flown into the fixed income. So we have seen income fund AUM really rising by almost more than 6 times as compared to the previous year.
6 times?
6 times, yeah. And again, that would largely be driven by expectation of interest rate cuts and so on. Gilt funds as well have done fairly well in terms of asset flow, like short-term income funds. Equity funds, on the other hand, while on an AUM basis there is some growth, it would largely be on account of mark-to-market gains. The net flows, if you were to look at equity funds, has been negative, and this is really, even if you were to look at the late numbers that have been published, that would be 8 months in a row for which the equity fund has seen negative flows at an industry level.
We'll drill down a bit more on that, but Lakshmi, clearly a great quarter as far as people like you are concerned, managing debt funds, huge inflows coming in. In fact, just to quote from the report, the investor interest in long-term income funds surged during the quarter, with the average assets under management for the category doubling as compared to just the previous quarter.
Absolutely. I think from a fixed income standpoint for the mutual fund industry, the product mix is significantly and it's tending towards the duration category funds, be it the long bond fund, the gilt fund, or the short-term fund. And I think it's clearly a matter of expectations. 2012 was phenomenal in terms of market expectations and investor expectations. And beginning 2013 calendar year, we've just seen RBI cut interest rates by 25 basis points. So the momentum is positive, and the underlying asset class holds the potential to perform in 2013 as well, and I think that's where we're clearly seeing the liability flow happening as well.
Let's look at some more numbers closely, and it talks about the fact that the average maturity of the also rose from 5.49 years to 8.4 years. How do you interpret this?
See, if expectation of falling interest rate, you typically try to run long duration, because that's where the sensitivity to interest rate lies. So if you're expecting an interest rate to come down by like 0.5% from these levels, so the longer the duration you run, the higher is the potential for capital gains. So that's the reason you're seeing collectively as an industry the average maturity go up.
Further on, the exposure to government securities increased while the allocation to certificates of deposits and commercial paper reduced. Why did that happen?
Now again, government securities are basically the primary market which has the direct impact of a fall in interest rates, and intuitively when money comes into these duration categories, especially the bond fund and the gilt fund, that is where predominant asset allocations lie to. And whereas commercial papers and certificate of deposits, it's not they can't be part of bond funds, but typically they find favor with a liquid or an ultra short-term fund. So there you've seen maturities, you've seen outflows because of the short end of the yield curve going up because of the tight liquidity, and there in the amount.
Anand, was this more a quarter as far as small and mid-cap equity funds were concerned from the point of being top performers? And before you go into that, how would you analyze the quarter that has gone by? What's really going on in the markets according to you?
Sure. So the key difference which I see that has happened particularly in last quarter but over towards the last 6 months is early on the bulk of the money was ETF money, as far as which drove the market. The FI money is the key driver of the market. And within that, the bulk of the money was actually an ETF money. So, there was not so much of, stock picking play. Largely, the large caps drove the market early on. It's only towards the later part of the year that people got convinced, and there was some flow into long-only funds, which were non-ETF. And that's where the mid-caps really start working. So the stock picking opportunity actually plays once the money started flowing beyond ETF funds and into long-only funds. And that's how, if you see towards the last quarter, you had significant, over a also you had a significant outperformance, but more so in last quarter where mid-caps really took off. And
so where are we now?
I think this year, we believe will further continue the trend of the last quarter, where will be a year of stock pickers, and the sector and stock specific moves will be more important in overall markets. Unlike last 2 years, particularly 2011 calendar year was practically, mid caps were actually getting rogered and large caps were also as well falling. And the last year, it's only toward the end that we had a stock picking opportunity. So I think this year will be very different from the last 2 years, where we will see more and more stock specific or a sector specific move.
So on a broader basis, last year was a great year. We've on the broader indices, we were up 25%. From a broader market point of view, therefore, are you saying it's not going to be as great a year as 2012 was, but there will be opportunities in individual companies?
Yes, definitely. To me personally, if you talk of broader markets, one should not really expect this sustaining, given the macro headwinds still are around. So while we are looking at a lot of positives coming in from policy announcements, we'll have to put policy in action. The moment you'll put policy in action, there will be inflationary impacts, and to that extent, and the slowdown will continue. Yes, you will have a sentiment positive, but the entire rally of the last year, so valuations are not as cheap today. You still have a slowdown which will continue to hurt, and you'll have a tailwinds of interest rate cut and softer commodity prices if we get this year. So market will remain resilient rather than really raging from here. And within that, then you'll have a stock specific, sector specific opportunities.
So you're not in that camp which believes sooner than later we'll be taking out our all-time highs?
Through the year, over an intra-year we might take over, but I'm saying one cannot expect surge of the market as a whole continuing unless there's some drastic changes.
Jiju, what did you find distinct in the funds that came out number one this time?
Okay. See,
equity first, then we'll talk about debt.
So within equities, small and mid caps were the funds that really did the best within all the different categories, and clearly the key driver in terms of the rankings was clearly performance. We have 75% weight that is assigned to performance in our rankings, and the top funds really did well in terms of the performance over a 3-year time frame. What is also interesting in terms of equity funds per se is that while the small and mid cap category did well as compared to the rest of the universe, the category average was actually lower than the benchmark. So they couldn't really outperform the benchmark over the quarter gone by, whereas all other categories actually outperformed the benchmark index. Of course, over a longer time frame, all fund categories have actually done better than the benchmark. In case of debt funds, specifically the long ed funds, what we have really seen is exposure to long duration bonds has really helped and helped them get significant returns as compared to years. And in fact, if we were to look at average maturities, the average maturity for our top ranked funds was higher. It was around 12 years as compared to the category average of around 8 years. So clearly the exposure to longer dated bonds helped funds move up the rankings.
It's an interesting point you make that most of the funds in your top quartile actually beat benchmarks.
Right.
Because that's been one of the concerns of investors, that when I go to a mutual fund, does it beat the benchmark? Do I do better? So what you're saying is fund managers like you were able to beat it.
Yes. And
why?
India offers tremendous opportunities to do stock picking. India, unlike many other emerging markets, is very diverse. You have umpteen numbers of sectors, within that number of companies, and you have a private sector, public sector. Very clearly, there are stock picking opportunities which India offers, which not many other emerging markets would offer. And that's why over a 10-year, over a 15-year, if you see the outperformance of mutual funds, is incredible. And it's been sustained over the last 15 years. There are pockets, there are times when you would have a mutual fund as a category maybe underperforming a benchmark for a while, but over a longer period of time, we have seen Indian equity markets offers opportunities for fund managers like us to continuously outperform the benchmark.
Okay, I'm going to talk a bit about what happened in January with the RBI, Lakshmi, with you, but we'll just take a quick break. We'll be back in just a minute. Welcome back. You're watching this special mutual show. Lakshmi, let me come to you. One of the things that the CRISIL report talks of is that the inflows came in largely from HNIs and corporates in anticipation of a reduction in interest rates from the Reserve Bank of India. Sure. We see that quarter of a 25 basis point cut which happened. Some would say they expected more, but at least it was by and large in line with the consensus. Sure. What is your own sense going forward? Are you in a camp which believes that we will see aggressive cuts, because most experts are talking of a maximum of 125 basis points all through this year, 12 months?
See, I think if you go through the recent policy statement where RBI has done a 25 basis repo rate cut, and that was the first in 2013 and a good 9 months later in FY13, it's clearly made it contingent on future that would really decide the next quantum and obviously the pace of rate cuts. And key among to watch out for that is inflation. We've just had today the inflation data for the month of January, which has come in quite lower than market expectations. At 6.6%, it was a significant departure from the market consensus of about 7%. So I think incremental data points such as this, we have the mother of all events, which is the budget end of this month, and most importantly the GDP data for the third quarter. If the I would say the positive rub-off of the inflation continues well into this the GDP data number as well, market the CSO has projected a very low number again compared to market consensus, and if that were to fructify, then we're clearly looking at incremental rate cuts starting March itself. But I think not getting into the timing part of it, I think we do agree that we need rate cuts in India more as a hygiene factor, though I do agree that it's not the only reason that will really sort of help to pump prime growth from these levels, but clearly it is required as a catalyst to push growth to the next trajectory, at least for FY14. You
talked about budget, so what would be the 2 or 3 things you would be looking out very closely for?
I think clearly from a bond market perspective, it is the fiscal deficit, because that is what translates into the borrowing program and therefore the supply into the market. Incrementally, RBI's ability to do open market operations is contingent on of course, and the projection of money supply. So I think the fiscal deficit is going to be the most, I would say, watched number from a market standpoint. And of course, if the number were to be close to the number that the finance minister has targeted, how exactly are the revenue side of the government balance sheet really going to pan out to be able to achieve that number? I think that's going to be the single most event within the budget that markets would be interested in.
Given all that you articulated, Lakshmi, going forward, and I'm not trying to ask you for a projected return or something, sure, but do you think that from an investor's point of view who's putting money into an income fund, and it's good to see people coming in and actually also putting in money into debt funds, retail, right, the horizon looks good, better according to you?
Absolutely. We clearly believe that 2012 was a very favorable period for fixed income investors, and 2013 with a 1-year kind of a horizon of investors were to look at long duration strategies, we believe there is merit in doing so.
Anand, how do you fight the fact that there is this whole push towards safety, towards more bank deposits / income funds? And then, of course, you have real estate and, most importantly, gold. So you as a fund manager are battling with all these dynamics. How do you see that playing out as an investment class, equities? You made the point about the difference between the last 2 years and this year. But again, from an investor's point of view, is this a good time to be investing? I know it's always a good time to be investing in equities, but would it make far more sense, according to you, to be reasonably exposed at this point of time in equity with a 2 to 3 year kind of a time frame?
Sure. But before I answer you on specifically for 2 to 3 years, I'm saying from a longer perspective, for your long-term savings, I don't think equity investing is optional to a real investor. If you ask me, if somebody were to plan his own retirement, 10-year, 15-year, 20-year goals, time will tell, and we have seen in the past that equity tends to outperform most of the other asset class. On top of it, it provides you diversification opportunity, which most of the other asset classes won't. So here within your 15,000 rupees savings also, you get to invest into 30, 40 odd companies and within that sector. So, there's always a chance that one sector might, but the other sectors will do well. And that's how we generate alpha. Coming back to the 2 to 3 year perspective and competing investment opportunities, to me personally, a lot has happened over the last 3 years is also to the mutual fund industry is also because we were in an environment of rising interest rate, which typically doesn't augur well for intermediaries like us. And to that extent, we lost out to bank FD or inflationary asset classes like gold and real estate. That's turning. So first round, the immediate beneficiaries are the fixed income funds. But sooner or later, we believe as interest rate continues to be cut and the equity returns start looking good, markets become a little more stable, we will get the investors back is what I believe. So from a 2 to 3 year horizon, while index is back at 20,000 and people worry that it's again at 20,000, one needs to watch out that 21,000 in 2008, the valuations were something like 6 times price to book, 24, 25 times 1 year forward. Today, the same 20,000, 21,000 numbers, you're far cheaper in terms of price to book. We are around 2.5 times. Price earnings ratio is lower. So both these numbers are very different. Though numerically they are same, but the markets are cheaper. And to that extent, the risk reward is much more favorable. There is more upside than a chance of a downside over a 2 to 3 year horizon.
Jiju, from the redemption point of view, one of the biggest challenges people like Anand have faced is the fact that on the one hand, they would want to invest, but on the other hand, investors were leaving, obviously redeeming. How deep is that problem? Do you think at some point this will be done?
Yes, I think a lot of it really relates to awareness. If we were to look at investor behavior, people, if you were to just look at retail investments, people really try and time the market, which is not really a successful sort of a strategy. There is a lot of initiatives that are being done from the point of view of both the regulator as well as market participants to increase investor awareness. And one of the golden rules is really invest consistently. Having said that, I think a lot of it also relates, just going back to the awareness part, relates to the expectations. So till now, a lot of the expectation within equity was that you would really make significant returns within, say, 3 to 5 years and so on. That clearly is not the case, as what we have seen. If we were to look at the 5-year return, even as of today, it is very close to 1 to 2%. So clearly, people need to have realistic expectations and at the same time be aware of the risks that are involved with different asset classes. I think a lot of that would really come in through investor awareness and the different programs that are being conducted. And clearly, mutual funds are ideally best suited for a retail investor. And it's not just equity, even fixed income for that matter. We just spoke of a lot of interest from corporates and high net worth individuals. But then fact of the matter is India is a country which really invests a lot in fixed deposits, which is in a way a debt sort of an instrument. So I think there is a lot of opportunity there as well, really, to convert fixed deposit investors to at least take debt-oriented products. I think a lot of it really will come in by way of greater investor awareness.
Anand, Lakshmi articulated what she's looking at from the bond market's point of view as far as the budget is concerned, since it's barely a few days away now. From an equity market point of view, what should I be looking out for?
I think what Lakshmi said was very clearly, fiscal deficit is a number which is relevant for fixed income, is relevant for equity markets equally. More over and above that, if I were to go one step forward, we also want to see the size of the budget. We want less of government. So, the fiscal deficit should not be achieved through higher taxes and higher expenses. We would want to see less of government, less of expenditure. And then within that, the quality expenditure, which is the classic debate happening between planned and unplanned, non-planned expenditure. So, single largest thing which we are looking at is the quality of fiscal deficit over and above absolute fiscal deficit also. We want to see more stable taxation policies, if they can give more clarity on saying, because every now and then we are hearing newer taxes, but that's not augurs very well for not only domestic investment, because what India needs today is the investment cycle to kick off. So the domestic entrepreneurs and the global entrepreneurs will look at more stable tax policies.
How serious is the liquidity issue out there, and how are you looking at that from going forward point of view? And secondly, from whatever that you are seeing and the way the bond markets are playing, what is your sense of the investment cycle turning? Are you getting any such sense from the markets?
Okay, to answer your first part, I think the liquidity situation to an extent is also engineered by the government, because the government is just not spending. So we see huge surpluses, though the official numbers are not available. We believe if some portion of that finds its way into the market, you will see some sort of a reduction in the liquidity. But it doesn't look like happening anytime soon, because there is a great resolve from the government side to really curb the expenditure, both planned and unplanned in this particular case. So we don't see the liquidity situation easing out anytime soon. In fact, our view is that it would get further aggravated as you have the typical mid-March advance tax number. And to that extent, we've already seen a 25 basis CRR cut on the 29th of January. We also saw an open market operations being announced a couple of days back to the tune of about 10,000 crores. So the idea is, we believe that the liquidity situation probably would start looking better only from the first quarter of FY14, which is why we've already seen the short-term interest rates go up. On the second part, is the investment climate really changing, or do we really see a decisive change at this point in time? Answer is no. We clearly believe that is still a phase where you will see interest rates being stable to benign, probably then a gap, and that could be a gap of maybe 2 to 3 quarters. By then you would have some kind of a stability on the growth numbers, incremental numbers, the way it would go forward, and then probably we'll start some sort of an unwinding of the current policy. But I think for a good part of the 2013 calendar year, the benign stroke stable interest rate scenario is here to stay.
All right, we're out of time. Thank you very much, Lakshmi, Jiju and Anand, for joining me here on this special discussion. Well, we've talked about the quarter gone by and what is coming. We will, of course, catch you next quarter, again, like always, to discuss how you should be managing your money and how are the funds performing. Thank you very much for watching this special discussion.